Roth conversions can certainly be a smart move in your retirement income plan, but if you're not careful, you can go too far and end up paying taxes that you didn't have to. You know, most people think the only question is, how much can I convert without going into the next bracket? But that's just one piece of the puzzle. The real question is, how do you know when to stop? How do you know when you've converted enough? In this video, I'll show you the hidden danger of converting too much and how to find your personal sweet spot, the point where you're getting all of the benefits without giving up future tax-free opportunities. When it comes to Roth conversions, there are really three decisions that you have to make. First, you have to decide, is a Roth conversion even worth it for me? You know, that's where the tax math starts. You'll take a look at your tax brackets now and in the future and figure out if paying some taxes today could save you more down the road. And once you've decided then that a Roth conversion does make sense for you, the next question is, how much should you convert each year? Now, a common approach, one that you've probably heard, is to just convert up to the top of a certain tax bracket each year. So, for example, many people try to fill up the 12% or maybe 22% bracket annually until their required minimum distributions kick in, or they may convert up to a certain IRMA threshold. And I get that approach. It's clean, it feels smart, and it's probably the best way to make a decision about how much to convert on an annual basis. But let's be honest, that's really just tax management for today. It's really not a true long-term strategy that's more focused on the short-term tax bill. And if you don't look out at the long-term big picture, it could come with some repercussions. And then we have the third decision, and honestly, this is the one that trips most people up. How much should you convert in total? Should you aim to convert everything from your traditional IRA, or is there a smart reason to leave some of the dollars in a pre-tax account? This is where things get tricky. But here's the good news. There's actual math that can help you figure out what your optimal conversion amount is. Not too much and not too little, and you'll find that sweet spot for you. And that's what we're going to cover today. I want to walk you through the three key things that I always advise people to think through and how to use them to figure out what that right amount is for you and your individual situation. But first, I do want to talk about the all or none trap. Before we jump into those key three things that you have to think about, there is a very important behavioral trap that we have to address because it does trip a lot of people up, especially those who like clear-cut answers. And I'll admit, I'm wired that way myself. Once someone decides Roth conversions are a good idea, it's easy to think, well, if this is good, why not go all the way? And on the flip side, if someone hears that conversions may increase their taxes in the short run, their gut reaction may be, forget that, I'm not touching this at all. And that's what's called binary thinking, or that all or none mindset. It's incredibly common, especially when you're dealing with something complex like taxes. In fact, studies in behavioral finance show that the majority of people naturally simplify decisions this way when the details get overwhelming. But here's the truth. Roth conversions aren't all or none. The smartest strategy is almost always somewhere in the middle. There's a sweet spot, an amount that gives you long-term tax savings, better control over your retirement income, and even a more efficient legacy. But finding that spot is going to take a bit of math and some thoughtful planning, which is exactly what we're going to walk through next. So, the first thing that we always consider when we're figuring out someone's Roth conversion sweet spot is this. Never convert so much that your adjusted gross income ends up lower than the standard deduction. Now, let me break that down. Let's go back through the tax formula like I have in several of my prior videos. So you start with your total income, then you subtract things like health savings accounts contributions or IRA deductions, and those are those above the line deductions. And after that, you have your adjusted gross income or AGI. And from there, you subtract either the standard deduction or your itemized deduction, whichever is greater, and the result is your taxable income. So that standard deduction, which is what most retirees are using, now acts like a tax-free zone. It's a portion of your income that the IRS doesn't tax at all, and that's why you don't want your future AGI to fall below the standard deduction. If it does, it means you left tax-free withdrawal space on the table, income you could have taken from your traditional IRA without paying any taxes. So in other words, don't pay taxes today on a Roth conversion for income you could have withdrawn tax-free later just by staying under the standard deduction. So to plan this out, you need to understand two key things. What will your income look like in the future? And what will the standard deduction be in those years ahead? And right now, that second part is a bit uncertain. We may get some clarity on this towards the mid to latter part of the year, and that's because the Tax Cuts and Jobs Act, often called the Trump tax cuts, is scheduled to expire at the end of 2026. And if it does, the standard deduction is going to drop significantly. But personal exemptions will return, which is going to change how much income is considered tax-free. And with the current administration, I think it's likely that those tax cuts are going to get extended or even made permanent. But nothing is guaranteed yet, for sure. So now, take a look at this chart. The blue bars show the standard deduction for a married couple filing jointly projected over the next 30 years, assuming the Trump tax cuts are extended. And the gold bars show what the combined standard deduction plus personal exemptions might look like if the tax cuts expire. And here's what you don't want to have happen, where your adjusted gross income, shown by this red line here, drops below that standard deduction line. That gap represents some missed tax-free income that you could have taken from your traditional IRA. So let's zoom in a bit and let's look at the year 2040. In this example, if the tax cuts expire, a couple that would have this level of adjusted gross income would still have about $24,000 in unused tax-free income. And if the current standard deduction is extended, they'd have nearly $38,000 of unused tax-free income. So, in either case, it wouldn't have made sense to convert more than needed and pay tax today because they could have withdrawn that amount tax-free later on. And that's why we never want to overcon convert. It's not just about what you can afford to convert. It's about not wasting future tax-free space. The second thing we always consider when deciding how much to convert is this: leave enough in your pre-tax accounts to cover your future charitable giving. Now, I know this doesn't apply to everyone, but I talk to people all the time that do engage in some level of charitable giving. And with this, I'm talking specifically about making charitable donations through something called a qualified charitable distribution. Now, I covered this in detail in a video I released not long ago, but here's the broad overview of how it applies to Roth conversions. Once you reach the age of 70 and a half, you can donate directly from your traditional IRA to a qualified charity, and it counts towards your required minimum distribution if you're subject to RMDs. But here's the big win with this. The amount you give through a qualified charitable distribution, which we generally just call a QCD, that amount is excluded from your taxable income. Now, that's different from taking a deduction. This never even shows up as income in the first place. So, if you're someone who gives to charity, let's say $10,000 a year, there's a strong case for not converting your entire IRA to Roth, because by keeping enough in your IRA to fund at least that $10,000 a year plus the standard deduction, you can use the QCDs to make those gifts completely tax-free once you're 70 and a half. That means you get the tax benefit without having to report the income and without needing to itemize your deductions. But if you had already converted those dollars to Roth, you would have paid tax on that money and lost the opportunity to give it away through a QCD. And if you tried to make the same charitable gifts from your Roth or from a taxable account, there's a good chance you wouldn't be able to fully deduct those donations, especially if you're taking the standard deduction like most retirees. And this stacks on top of the strategy that we talked about a moment ago, so keep that in mind. You know, in the first example, we said you never want your AGI to fall below the standard deduction because that's your tax-free zone. But if you also plan to give through these QCDs, you want to make sure that your AGI stays above the standard deduction plus your annual charitable giving. So in that $10,000 giving example, your real tax-free zone is the standard deduction plus $10,000, and you want to keep enough in your IRA so you can withdraw, or in this case, give that money without paying tax on it. So when you're thinking about how much to convert, think ahead to your future giving and leave enough in your pre-tax bucket to fund those charitable goals year after year. And that can save you thousands in taxes and make your giving even more efficient. And the third thing we always consider when deciding how much of your pre-tax to convert to a WTH is this: leave enough in pre-tax to cover the potential cost of long-term care. This is one of those areas that's easy to overlook, but it can make a huge difference in your long-term tax strategy, especially if you ever need medically necessary care later in life, like long-term care. Here's why this matters. If your unreimbursed medical expenses exceed 7.5% of your AGI, the amount above that threshold becomes a tax deduction. That includes things like home health aides, assisted living, and nursing home care, as long as those services are tied to a medical need. So, if you still have dollars in your traditional IRA and you end up needing long term care, you could potentially withdraw those funds while offsetting much or even all of the tax because you would have a large deduction in the same year and would almost definitely be itemizing in that case. But if you would have converted all of that to Roth, you lose the ability to match that future income with a future deduction. And you could still potentially get the deduction, right? If you're spending that, but you don't want to pay tax on it and then try to get a deduction later on. And that's why I recommend leaving a portion of your pre tax account intact just in case. You have to think about it like a tax smart reserve, something you can tap into for that high expense without triggering a big tax bill. Now, how do you estimate how much you would want to leave for long term care expenses? One of my favorite resources that you guys have heard me talk about on the channel in the past is the Care Scout Cost of Care Survey. It breaks down the cost of long term care by type, like home health versus nursing facility, and by location, so you can get a much more personalized estimate based on where you live or maybe where you plan to retire. And I can tell you there are some really big differences based on your location. Now, a simple rule of thumb is to just look up the current cost of care in your area. Multiply that by the number of years you want to plan for. Most people use 2 years, but some like to use a little longer, and then leave that amount in your pre tax IRA. You might get a little bit of inflation that happens on the medical side that doesn't match your growth rates, but as a broad rule, that's going to help. So, for example, if care in your area averages $90,000 a year, you'd want to leave about $180,000 in your IRA to cover 2 years of potential care. That way, if you need it, you'll have it. And if you don't, well, those dollars would still be passed on to your heirs. Again, the goal here isn't to guess the future perfectly, is to give yourself flexibility and preserve options that could result in low or even zero taxes when facing one of the biggest expenses in retirement. So, let's bring all of this together. With Roth conversions, the total amount that you choose to convert is one of the most important decisions you'll make for your retirement taxes. And as we've seen, it's not about converting everything, and it's not about doing nothing. There's a sweet spot, a range where you're not paying more tax than you need to today, but you're also not missing out on future tax-free possibilities. That sweet spot is going to take a little math, a little forecasting, and a good understanding of your personal goals. Now, I know that not everyone takes the standard deduction like we've talked about today. Some retirees itemize, especially in high property tax states, you or people that give heavily to charity. And we all know you can't plan for every contingency. We don't know exactly what care we'll need, what Congress will do with tax law, or how our spending is going to change from year to year. But that doesn't mean we have to plan in the dark. By keeping these three principles in mind, never converting below the standard deduction, leaving enough in pre-tax for your charitable giving through the QCDs, and reserving enough for long-term care expenses, you're going to give yourself a good framework for making smarter, more flexible decisions. There is a Roth conversion that's just right for you, right? And that number may be zero, but you need to get that number dialed in to get control and confidence for the rest of your retirement years. So, if you're trying to figure out how much of your IRA to convert and then when to convert that, it's not something that you have to guess your way through. This is exactly the kind of planning that I help people with every day. And if you want help finding your Roth conversion sweet spot, just head over to my website and schedule a time to talk. Let's make sure that you're not overpaying taxes now or leaving opportunities on the table later. Thanks for watching.